Today I'm going to cover, is gold a good investment? Also, I'm going to show you my future price prediction for gold, and I'll cover why gold is a good investment. So let's begin. Gold, what you need to know first about investments, real quick. Almost there's nothing that is always a good investment all the time. So stocks isn't a good investment all the time. Gold isn't a good investment all the time. Real estate, so on and so forth. A lot of investors make a mistake and they think that gold is always a buy. Gold is not always a buy. Let me show you on this Dow gold ratio. This ratio shows the price of the Dow divided by 1 ounce of gold. Um, Whenever this is high, this means that gold is a good investment. I'll show you some numbers that back this up, this point up. But you can see since 1915, it's only been high 4 times. One, two, three, four, and we're at the fourth point now, and it actually looks like there's a shift in place, which we'll talk about later. But it's similar to a Slurpee. Okay, I'm not sure if you're familiar with a Slurpee, but it's a drink that it keeps you cold in the summertime. So if you're going to say, hey, should I buy a Slurpee if it's 20 degrees Fahrenheit outside, it's very cold, and you're in New York and you're going to be walking around for 20 minutes? I'm going to say under those conditions, buying a Slurpee is pretty dumb. However, if you tell me it's 100 degrees outside, you're in New York and you're going to be walking around for 40 minutes, I'm going to say, it may be a good decision to buy a Slurpee under the hotter conditions. So it's no different than gold. These conditions call for an investment. These other conditions call for other assets to be invested in, such as stocks and those things. But, so that's, I guess, key number one is that nothing is always an investment all the time. However, 2018, 2019, 2020, gold will be an investment. Another thing you need to know is that gold is actual money. This dollar bill here, this isn't money. This is currency. If you look at the bottom here, this is an old silver certificate dollar. This $1, if you look at the bottom, $1 in silver payable to the bearer on demand. So this $1 used to get you 1 ounce of silver. $1, you take it, you trade it in for 1 ounce of silver. With inflation or with the increase of money, this $1 now gets you 1 ounce of silver. It still gets you the same 1 ounce of silver. Actually, let me take that back. This $1 doesn't get you the same 1 ounce of silver. This $1 gets you a percentage of an ounce of silver. So that 1 ounce of silver that used to be $1 is now $14. I'll say that part again. That 1 ounce of silver that used to get you, or this $1 that used to get you 1 ounce of silver, it would take 14 to 15 of these right now to get you 1 ounce of silver. So you can see the dollar has depreciated against money. This currency has depreciated against money, which you can say is silver, gold. It has value in itself. And you can see this sentence here. Do you think that a piece of paper is worth $100? It's only a piece of paper. But gold, if it's by weight, is worth a set value. And that's pretty much globally throughout the world, give or take. It should be around because it's actual money. Another key phrase here is that with inflation, everything gets more valuable except currency. So with inflation, the more money is made, which I'll show you shortly, the more money which is put into the economy increases pretty much the price of everything except that dollar bill there. It actually has a negative correlation, so it decreases. So gold can actually protect you against that inflation. Also, it can do more than protect because gold usually overshoots, which I'll show you soon to come. It usually overshoots, so it goes from beyond that protection into almost like a bubble. Gold also protects you against financial resets, which I'll show you. And currently, as of 2018, 2019, we're in a bull market, or it should be the beginning of a bull market for gold, which makes it a great investment. And gold has physical properties as opposed to, let's say, rice, and oil and those things, which makes gold a better investment. For one, it's lightweight. 1 ounce is worth about $1,200-1,300, easily a portability. It doesn't corrode, and it's a fixed amount of gold that's available in the world, which makes it a great investment as opposed to this dollar bill here. The dollar bills actually, they can be printed at ease. It's just paper, ink on paper, special paper, and that's the problem, which we'll soon look at. So I'll cover my projection for gold. Actually, yeah, let me go here first. So you can see gold was fixed to this $20. Whenever you see a huge spike, that represents like a reset, a financial reset. There was a revaluation of gold in 1934, is by the president. So gold went from $20 to $34, $35 here. Then you see this next big jump. This was in the 70s. And the key is, just to backtrack, when you know, or when you calculate that a reset is coming, you want to buy gold right before that reset. So if you if you purchased gold in 1970, you could have got it for, this isn't inflation adjusted, you could have got it for $36 for 1 ounce. And 10 years later, that same ounce, it doesn't even show here because it was a real quick spike, but it went to $850, which is a great return. And if you check the Dow Jones, I'll show you that period real quick. This isn't inflation adjusted either. If you look at the Dow Jones during that period, let's go to 70. This actually is, like, I know. Let me take that off. Let me go to 1970. The Dow Jones was about 790. If you go to 1980, that same period, the Dow Jones, we can actually go here, 1982. Dow Jones was only 822. So it went virtually nowhere in 12 years. And as you saw with gold, it went from $35 to $850. So let me go back to gold here. However, now, as I said with the Slurpee, if you purchased gold here in 1980, it would have been a horrible investment because you would have got it for $850. Remember, the $850 spike isn't shown, but we'll say 600 or 700. You would have got gold for $700. However, 2001, that same gold would have only been worth $200. Likewise here, if you would have purchased gold in 2011 for $1,700, which a lot of people did, a lot of actual investment pros, they held gold and they purchased more gold, and they had these wild projections for the price of gold, which didn't prove to be true. And they actually calculated the wrong price for gold. They made an error, which I'll show you the error that they made, but they missed out on a lot of money. But right now, gold is about 1220. It's actually been rising as of lately. So let me show you my price projection for gold. Also, yeah, before I do that, a key way you can purchase gold is you can buy the 1 ounce, a popular method. You can buy the 1 ounce American Eagles. You can go to a website, you can Google them, or you can go to your local coin dealer. You can just Google local coin dealer to find someone or a coin shop near you. So let me just go to my projection. Sorry, I have so many windows up. But yeah, here's my projection for gold. This is what I did. I took the M2 money supply. I actually need to show you M2 money. Yeah, let me show you this real quick. I took the M2 money supply, and this is the money in the economy that's is viewed as like near money, which is coins, money in wallets, paper money, actual physical money. Sorry about that. And also money that can be liquidated from bank accounts and like money market accounts within 24 hours. So it's a good interpretation or reflection of money in the economy. And you can see it here right now. This is in trillions. It's 14 trillion. So you can see it was 2 trillion, and it just goes right up. And you can see the last financial crisis, it was huge bumps in the increased drastically the M2 money. So I'll reference the M2 money, but I just want to show you, and you could just Google that if you want to take a look. But this is the M2 right here. Down here, this is in trillions, this is in billions. I simplified this because it was too many zeros. I removed 9 zeros and I just took it here, because that way to make the ratio look smooth, or else this would have been, a crazy, I think in the millions or billions of ratio, which is, it poses no good effect. But it smoothed the ratio here. So you can see this 46 billion, 46, and we have a ratio. Now, the key thing about this ratio is cyclicality in this ratio. And what I mean by that is that it does wild swings. The currency does, from being priced accurately to being priced incorrectly or inaccurately. So let's look. So you look at 1920. Whenever this goes to 1, or 1 or 2 around there, it's actually a good indicator to buy stocks. The higher this goes, is actually a indicator to buy gold or to invest in gold. And I'll show you the returns that you would have got. But keep in mind, before 1920 was at a fixed amount, so it's pretty much 1920 and before is irrelevant. But you can see 1960. This was high. Actually, let me go to 1935. Gold was priced. It was an act. I forget the name of the act. 1934. So gold was priced with the M2 money. You got a great ratio, 1.1. So let's call 1.1 the ideal ratio that you want to have. But over time, with inflation, this ratio gets out of whack, and then they make currency changes, or they reset the currency, which causes it to revert back to the 1 or close to the 1. So I'll show you. It'll make complete sense in about 1 or 2 minutes. So you can see it's 1 here. 1960, it went out of whack. It was 8, right? Gold was $35. However, you could still purchase stocks at that point and other assets. However, 1968, stocks were screaming, don't buy. This ratio here was 13. It was about 14, which screams buy, because the higher this ratio, the more, the greater your probability of getting great gold returns that exist. But it was 13. You see the gold price was 40. 1980, they reset the currency. Richard Nixon in 1971, he let the dollar pretty much run freely. He didn't tie it to any gold. He closed the gold window. So as a result of that, the gold price went from 40 to 850, and you got to this ratio of 1. It's like the golden ratio, let's call it, of around 1 or 2. After that, prices, they got out of whack. So this is 1999. You had a 15 ratio. Gold was screaming buy. This is when the gold price was 270. You had a reset. This is when the euro was actually introduced January 1st, 1999. So with that, you got is actually the dot-com bubble. You got a lot of bubbles, but you see the ratio got lower. It got to a 5. Now, this is the mistake a lot of investment professionals made. They thought that this ratio was going to go to 1. Had it went to 1, gold would have been about 9,000. But it didn't go to 1. It only went to 5. And that's a key lesson that the investment professionals and a lot of these guys, hundreds of $1 million, they were too greedy. When this ratio got to about, maybe 5 or 6, they should have unloaded a small portion, or they should have sold some gold, because keep in mind, they purchased the gold for 270 and it went to 1800. So they got great returns. However, they held on too long and the ratio didn't go to 1. It went to the ratio didn't go to 1. It actually went up to 12, by 2018. So 5 was pretty much the low point that it went. And I'll show you this on this dial code. I keep on making these windows smaller and smaller, right? But I'll show you here. So this is another ratio, and it's a dial. So this is another good representation of all the money that is in the economy, but the M2 is a better representation. So you can see here it went to 1, here went to 1. So they said, well, I guess investment professionals, they said, and this is Peter Schiff, this is Mike Maloney, a bunch of those guys. They thought it was going to go to this point, all the way to 1-2. However, it kind of faked them out. It went to 6. It didn't go down to the bottom. But let me pull this back up. So now, I actually have it modeled this time to go low. But even if it doesn't go this low, if it just goes to about 6, you can still make great returns, which I'll show you, which makes gold a good investment right now. But yeah, so 2018, this is all the money that's in the economy here. It's 14 trillion. Actually, yeah, this is about a month ago. This is the end of 2018. But yeah, so this is all the economy. This is all the money that's in the economy. This 14 trillion. I simplified it. I removed the non-zeros, and this is the ratio. Now it's 11.3. Last month it was 12.1. So the ratio looks to be on a decline, which means an incline or increase in the gold price. So after this point, because we don't really know, I did hypothetical, but you can, pretty much agree that these hypothetical situations will come into fruition, and I'll show you. So if we just keep the M2 money supply, and this is growing right now at about, I think it's about 400 billion a year. But if the Fed or if Donald Trump increases the money liquidity through like a basic income, or if the rates get lowered again, this is shoot up way faster. But right now it's growing at about 400 billion a year. So you figure, or yeah, like let's say 500 billion a year. So you figure this would increase 1 trillion a year. But let's say it stays at 14. Yeah, sorry about that. When I made a change and I had this document open on my other laptop. But yeah, so if this ratio goes up to 15 as it went in 1999, you can see the gold price would be 933. This is pretty much the lowest that you can expect gold to go, which isn't pretty low based on the current price. It may be about a 30% or 20% maximum decrease that you'd be looking at. However, let's look at the upside. If the ratio, as you've seen in the prior times, it went to 1-1, and the last in 2011 went to 5. If it just goes to 5, you're looking at $2,900 gold, which is always went to at least 5 in prior history. So this is kind of like, you can look at this probability as, let's say, wintertime in New York. What's the probability of the temperatures during the winter in New York reaching 20 degrees, or in the 20 degrees, 25, 26? You can pretty much you will pretty much have a high probability if you bet on those options, or if you invested money based on that criteria of New York having a 20 degree temperature in the wintertime. So let's look at another scenario. I have a bunch of scenarios here, but let's say if the money supply increased by 16 trillion, which it should be there maybe 3-4 years, if nothing drastic happens in terms of a monetary expansion. But if it's just at the 11 that it's at now, you're looking at a gold price of about 1,500. If it gets to the 5, which it at least has before, you're looking at 3,200. If it gets to a 3, which isn't as low as the 1 and the 2, but if it gets to a 3, you're looking at 5,000 gold. If it gets to a 1.8, you're looking at $9,000 for 1 ounce of gold. And you can see I just have a couple of other examples here. So this may be a few years out, but if you're looking at 18,000 or 18 trillion in terms of the M2 money, and you put a 5, you're looking at 4,000. You go to 1.8, you're looking at 10,000 an ounce for gold. And I took it to an extreme of, let's say, 20 trillion. With the 1.8, you're looking at 11,000 gold price, or $11,000 for 1 ounce of gold that is now 12. So you see the maximum upside is, let's say, realistically about 16 trillion, but the maximum upside is about 9,000 realistically. And keep in mind that the previous points, it hit 1.8 times 70, or 1.8, the ratio hit 75% of the time. So it's like, if you give the ball to a 3-point shooter and he shoots 75% from the line, you have a high chance, if it's a buzzer beater, you have a high chance of winning that game. If he's able to just hit that shot at 75%. But the upside, realistically, let's say is about 9,000, whereas the downside is 933, and that's based on this ratio getting to the high that it got to in 1999 based on the M2 money. So if you look at your risk reward, it seems to appear that gold is in a great place to be an investment. So let me know what you think. If you think gold's a buy. If you like this video, give it a like.
Thanks for watching. To subscribe for more financial content, please click the circular button where the red arrow is located, and also watch one of the top 2 videos up top.